Hi, welcome to this video. We're going to be looking at the basic reason that a lot of traders have, and that is why do most retail traders end up losing money? Now, before we proceed and we get into the details, this is a disclaimer that whatever content you're going to be getting in the next few minutes is only for educational purposes and it is not any kind of a recommendation. Whatever information I'm sharing is from my experience. It is my opinion, and everybody is requested to evaluate this information at their own end. And none of this is basically any kind of investment or trading advice. So, going ahead, I have not created this video from a purpose of having a complete guide. I did not want to mention the top 10 reasons or the 20 reasons why retail traders don't make money. So we will be focusing on the two basic reasons, which are basically responsible and they differentiate a successful trader from the one who has been consistently losing money. And the first reason, in my opinion, that most retail traders lose money is because they are making directional bets. And that's why I have mentioned here the first reason as directional trading. What I mean by directional trading is basically trading strategies where you expect the prices to either go up or to go down. And this is one of the primary reasons why most retail traders end up losing money. Uh, it's very, very difficult in the market to anticipate what the prices are going to do in a particular time frame. So whether a stock price is going to go up tomorrow or day after tomorrow or next week or whether it's going to go down, it's very, very difficult to anticipate that. If your entire trading strategy is based on a directional bet that a stock is going to either go up or go down, then you basically are expecting the stock to do something over which you have no control. Retail traders do not bring in the kind of volumes that institutional investors have. So you cannot influence the price. Buying 100 shares, 1,000 shares is not going to increase the price or decrease the price of an underlying share significantly. So, what do we do about this? I mean, most of you would say that we are getting into trading, so we expect the price of a share to either go up or go down. If that is not the case, then what alternative is there? How can we make money trading? So the solution to this problem is not to buy shares and not to sell shares, but rather to sell option premium. Now, what do I mean by this? Options can be bought and sold on a lot of underlying shares, and these options have a value which has two components. One of the components is the intrinsic value, which basically indicates the in the money value of the option. The rest of it is time decay, which is basically time value. And time decay is something which can be used to our advantage as traders because let's say uh, there is a share ABC which is trading at $100, and I can go and sell the $90 option, put option on this particular underlying and probably collect, let's say, a premium of $2. So I'm selling the 90 strike put option and collecting a $2 premium on a share ABC, which is trading at, say, $100. Now, in this case, if the share ABC does not go below under $90, this option is going to expire worthless. So let's say the option had a time frame or an expiration of uh, 1 month. Then within that 1 month, if ABC does not fall down from $100 to anywhere less than $90, this particular option is going to expire worthless. And so the premium of $2 that I collected upfront is mine to keep. Now, this thing does not require the price of ABC to do something specifically. We don't need the price of ABC to go up. It can stay where it is. We don't even want the price of ABC to either be at the same place of $100 or to go up. It can even come down by $10 to $90. So, from the situation when you are buying outright shares and you can make money only if they go in a direction in which is in your favor, we have brought ourselves into a situation where we make money only if the share price does some specific exceptional move, which is going down, and then not just going down, but going down by $10 and going below the $90 mark. So you can understand that the chances of making money, chances of keeping that $2 with yourself, which is the premium that you've collected upfront, are way higher than the chance of buying the stock at 100 and then expecting it to go up. Because if you're doing an outright trade, let's say you're buying 100 shares of ABC at $100, then you make money only if the stock price starts going up above $100. So, in any other chance, you either don't make any money or you lose money. But with the second strategy that I told, that is selling option premium, you make money if ABC price goes up. You make money if ABC price stays at $100. You make money if ABC price falls, but it stays above $90. So this is the advantage of selling option premium. Now there are different ways of selling option premium. The one which I mentioned is technically known as selling naked puts or cash covered puts. And there are a lot of other strategies where options can be sold in order to generate uh, income. And my recommendation is not to get into directional trades, because you can analyze a particular market, a particular stock, a particular index fund as much as you want. But none of us can know how the market collectively, the hundreds and thousands of traders, the institutions, how would they react, and would they push the prices up or would they push the prices down the next day, the next month, the next year. It's very, very difficult to anticipate that. So we need to follow a conservative approach where we are increasing our odds of making money. And that is by using a strategy which does not force us to see the stock move in a specific direction, to see the stock do something specific so that we can make money. Instead, we want to be in a situation where the stock is free to do a lot of things. It can go up, it can stay where it is, it can go down by a certain amount. In all cases, we make money. Only if the stock does an exceptionally downward move, we don't make money, right? And in that case, also, for the example that I gave, you would actually end up buying the shares. Let's say the price was to go below 90. In that case, you would buy 100 shares of ABC at $90, but you've already collected $200 in premium. So the effective cost of ABC shares would be $88. Now, if you were looking to buy shares of ABC at $100, I'm pretty sure it's a good deal if you're forced to buy shares of ABC at $88, right? So even in the worst possible scenario where the price actually goes below $90, this strategy basically makes sure that you are buying shares, but then you're buying it at a much better price that you would have got in case instead of following this strategy, you would have outrightly gone and bought the shares in the open market. So this is an important factor here, that time moves only in one direction. Time doesn't go back. So the time decay is always and always going to work in your favor. Now let's look at the second main reason, which in my opinion is the primary reason for retail traders to lose money. And that is that most retail traders end up selecting a very short time frame within which it is very, very difficult to be certain that the price move or any other movement that is needed to make money can possibly take place. So let's say, again, we'll take the example of ABC, where the share price is $100, and let's say you're buying shares, okay, but you end up uh, buying shares, and then you've held the shares for 2 months, and you were expecting about a 5% profit. So you expected the price to go from $100 to $105. But in the first 2 months, nothing actually happened. In fact, let's say the price dipped down to $99. So you got frustrated because the stock is not behaving as you expected it to behave after all your analysis and all the judgment that you could gather. So, what do you do? At the end of 2 months, you went and sold your shares, only to see that in the third month, after 3 months, the stock price actually rallied up all the way up to $110. Now, this is a situation which happens with almost all of us. We get into positions and then we get irritated, we get frustrated because the stock is not doing what we want it to do. And then we exit that position or we are stopped out of that position a lot of times, only to realize that a few weeks, a few months later, the stock actually did make a significant move in the direction that we were earlier anticipating. So, in order to uh, understand this, what if you held the stock position for a very long time? Now, if you've seen the reason one and the solution I gave, I have suggested that in order to overcome the first problem, which is the directional nature of trading, I am uh, of the opinion that traders should be selling option premium. So, extending the same context to this reason, the time frame, essentially what I'm trying to say is that you need to deal with options on a sufficiently longer time frame. So there is a set of options called leaps, which are basically options which have a long time to expiry, let's say 2 years, and those kind of behave like the underlying stock a lot many times. So whether you are trading shares, whether you're trading options, one thing that has to be kept in mind is that you need to give the underlying enough time to react. So let's say instead of selling option premium, you were actually buying the stock or you were buying options. In both cases, you need to have a longer time frame. If you're buying a call option, right, which is expiring in 1 month, and within 1 month the price of ABC does not go up, then you're going to be losing that premium. So even if your judgment is correct, even if your analysis is correct, and ABC does go up 2 months later, you've lost that premium. The only way you can capture that premium is by getting into an option trade which is not expiring immediately, rather it is expiring in a longer time frame. So you have enough time, let's say 6 months or a year or 2 years, for the trade to work out in your favor. So these are the two primary reasons why most retail traders lose money. Now, specifically, if you ask me, I would uh, uh, like to see myself selling option premium. That's the first rule. And when I'm selling option premium, I really don't have to bother about the second rule, which is time frame, because even on shorter time frames, the if the move doesn't happen, because the second reason, if you see here, is all about taking care of a situation where you want a stock to go up in value or down in value, but you want to give it enough time to be able to do that. So only if you are a net buyer of options or you're buying stock or you're shorting the stock, then in that case, you need to look at longer time frames. But if you're selling option premium, it really doesn't make a difference, because if you sell uh, shorter term options or whether you sell longer term options, in both cases, as time passes by, you are going to get the money because of time decay, unless the underlying makes a very rapid move against you, as we saw in the earlier example. So, if you're selling option premium, then in that case, you don't have to worry about this reason, and therefore, you don't have to worry about this solution, which is to either hold the shares for the long term or to basically buy call options. If you're buying call options or you're buying put options, if you're a net buyer of options, you need to buy the options which are not expiring in a week, in 2 weeks, in 3 weeks, in 4 weeks, in shorter time frames. Because if you're betting on a certain stock to dip down and you go out and buy a put option, that stock may actually fall. If your analysis is correct, if you're confident, that stock may actually go down in price and your put option can make you a lot of money. But if you don't give your put option enough time to basically uh, expire after the stock has made the downward move and the option expires, but the stock doesn't make a move till then, the stock actually starts moving after your option has expired, then you're simply losing that premium which you're paying to buy the options. So I personally do not like to buy options unless the options are selling very cheap, and I have a very significant reason to believe that this particular directional trade is going to get me really good returns. I personally do not like directional trades because uh, it's very difficult to be correct on directional trades, and there's no point getting into one trade which does gives you a very good return, but then have another trade which wipes off those returns because the stock did not do what you expected it to do, and you basically lost all the premium that you had paid. The only way to make money trading is, number one, don't lose money, and the second way is, whatever money you make, you need to make it consistently. You don't want to hit home runs. You don't want to have trades which give you 500, 600% returns, but then on the other hand, have a chain of trades which basically where you're losing all of your premium and you're losing all of the money that you're investing. So consistency is the key. If you can get 10, 20% returns on each and every trade, that is more than sufficient to be a successful trader, to be a successful investor. And in my opinion, these are the two primary things. Number one, stay away from directional trades, because the moment you try to do directional trading, you're basically expecting the stock market to do something specific, either go up or go down, which is beyond our control. So it's better to have a strategy which is not dependent on the direction of the market. It can go up, it can go down to a certain extent, it can stay where it is, and in all situations, you make a decent amount of money. That's a much better, much more consistent, much more stable approach that can be followed. And if at all, for some reason, you are uh, buying options or you are buying shares, then in that case, uh, try uh, an attempt should always be made to make sure that you're giving enough time for your strategy to work out. Don't get into very short term option trades which are expiring in a week. Even if you buy a call option on a stock which is expiring in a week, what's the guarantee that the stock is going to shoot up within the next 7 days? If nothing happens, then you're basically losing that premium. So if at all you have a very strong conviction that the price of an underlying is going to go up or go down, and you're buying the call or put options based on that, then at least pays that slightly extra premium to have enough time frame so that your options can actually show that kind of a return, because the underlying had enough time to make that move. We do not have to expect the market to move. The moment you start expecting the market to do what you want it to do, you're in trouble, because the market is going to do what it's going to do. As traders, as investors, we need to align, we need to understand and identify the cycle in which the market is. We need to understand what the market is telling us. We cannot just expect the market to do what we want it to do. Instead, you need to start listening to the market and accordingly uh, place your trades, place your investments so that you can make money. So, thank you for watching this video. And if you have any questions, queries, suggestions, please leave them down in the comments and I'll be happy to respond to them. If you have any specific requests for any for information on any specific topics, you can list that out and I will try to get back to you with that information. Do subscribe to the channel if you've not already done that, and please share this information if you found it useful. It will be good to hear from you. A small comment would go a long way. Thank you so much, and see you in the next video.